there will be a significant amount of bond sales required. When a bubble is created, it usually causes a disruption. You are aware that the Federal Reserve has recently printed massive amounts of new currency. The cumulative effect of this enormous expansion of the money supply is widespread improvement in the state of the financial system. Recently, Ray Dalio shared his opinion that the Fed had cornered the financial markets. Dalio is a master of macroeconomics, a skill that has allowed him to successfully oversee $150 billion. For decades, countries have sought out Dalio for every concern about the field of economics for advice, which is why in this video here at Tech Tank Titans, we'll explain in great detail what these adjustments are and how the Fed has essentially imprisoned itself. Let's jump into it, but make sure to give this video a like and subscribe. First of all, don't expect one of those videos warning you about an impending crash. Although we're not here to spread panic like some others have done, we do not believe it is possible to predict when the market will crash with any degree of accuracy. The circumstance we're in now is quite unusual, and it could have serious consequences. The Federal Reserve has been buying enormous amounts of bonds, a policy known as quantitative easing. In recent months, bond prices have risen unnaturally due to the government's increased purchasing power. There is an inverse relationship between bond prices and bond yields. Bond yields must fall when bond prices rise and rise when bond prices fall. While the current inflation rate is well over 2%, the yield on the 10-year Treasury is only 1.5%. Despite the fact that bond investors may anticipate positive real returns, or returns after accounting for inflation of 1.5% annually, the real returns are really negative due to inflation. The Federal Reserve should sell some of its bonds to lower bond prices that have been inflated artificially. This is already beginning to take place, as we have witnessed. The Fed has decided to begin selling off corporate bonds and corporate bond exchange traded funds, or ETFs, that it bought in the midst of the pandemic. It's worth noting that the Fed has started to move toward talking about possibly shutting down bond purchases. You might conclude that the Fed is decreasing the amount of bonds it buys based on the data you just saw. In contrast, Ray Dalio believes the Fed is in a very different position. The Federal Reserve, in his opinion, will soon be compelled to buy bonds rather than sell them. That might not make any sense at all at first, but upon further observation, it starts to make a lot more sense. Large institutions have stocked up on Treasury bonds to play it safe in anticipation of a possible worsening of the pandemic. In this way, they will be able to continue operating should the crisis develop. Bond prices will plummet once these institutional buyers start selling bonds to buy other financial assets including stocks, real estate, and foreign equities. To prevent the selling pressure from causing a crisis, other financial assets may produce much larger returns. If bond prices rise, the Federal Reserve will have to buy bonds, which will boost the money supply. The term monetary inflation is used to describe the situation when it occurs in the financial markets. Because of the increasing allure of financial markets outside China's, we are experiencing a supply and demand mismatch in bonds. If there isn't enough demand, bond prices could rise and cause monetary inflation. If the bond bubble bursts, as some fear it will have a devastating effect on the value of all investments. The Federal Reserve intends for interest rates to remain at historically low levels, which will fuel bubbles across the board. Institutional investors, for instance, are taking advantage of historically low interest rates to amass property holdings. In addition, investors' margin debt in stocks, cryptocurrencies, and commodities continues to rise, and businesses keep taking out loans for growth. Assets that have been inflated by historically low interest rates would suddenly plummet if rates were suddenly to rise. Loans with interest are being made, even though the interest rate is close to zero, as far as I can tell. That is to say, you are under no obligation to make a lump sum payment toward the principal. With so much cash being exchanged hands, I'm more worried about the things that lead to a bubble forming. You saw how the markets responded when the Fed hinted at tightening. To prevent a complete collapse of all financial assets, the Fed cannot simply let interest rates rise, as Dalio has pointed out. Instead, the Fed must buy bonds. Prior to the actual occurrence of this event, Dalio believes that investors might make enormous profits by buying Chinese-related assets. It was the United States that was impacted most by the pandemic, while China had already fully recovered by that point. The upshot is that American companies are importing more goods from China. The result is a widening of the already existing imbalance in the balance of payments between the two countries. A country's overseas dealings are recorded in its balance of payments. The current account and the capital account make up half of a balance of payments. Every item sold or purchased abroad, as well as any money sent abroad, is part of the current account. Stocks and other foreign financial assets are included as investments in the financial account. Since Chinese companies have acquired a large quantity of US dollars, they will need to use these dollars to purchase US items for import into China. Buying US stocks or bonds or exchanging dollars for the Chinese currency. One way or another, the value of the US dollar relative to the Chinese yuan must rise. This is because the value of the US currency falls when the Chinese companies use the reserves of US dollars to buy goods or invest in the financial assets in the United States. Dalio thinks Chinese assets are a fantastic way to protect your wealth from the effects of US dollar inflation. To start, we'll go over the most promising alternative asset classes. I liken the current position in China to late 1960s and early 1970s when the United States had a different core inflation rate from Germany and Japan. The international payment scenario is unique. We have a trade deficit, whereas they have a trade surplus, which suggests that they are concerned about imported inflation earlier in time. Moreover, positive capital inflows are likely to have a negative effect on the dollar, especially when traded against Asian currencies. According to Dalio, a bubble has formed in U.S. financial assets. Since many equities are trading at lofty price points, it becomes more challenging for investors to identify attractive bargains. A lot of money is floating around and being flung around, making for a more challenging scenario than usual. Inflation in financial assets and the like is an issue related to liquidity, which we believe is necessary for those returns to be justified. To clear things up, lower long-term real returns in financial assets are extremely likely, but a crash itself is by no means guaranteed. Outstanding financial gains have been experienced by individuals over the past year. Don't assume this market will keep returning this much though. Some equities may have significant gains, but chances to do so will be far more rare. This is because a lower correlation between future returns and present prices is to be expected as asset values grow. There's a negative correlation between the stock market. Similarly to how a gain in the stock market causes bond yields to fall, higher stock prices also tend to push dividend payout ratios lower. Total financial assets are reduced due to the term's predicted future rates. Real returns over the long term are expected to be lower as are asset returns over the long term. Indeed, investors who have placed their money in the asset markets have gained significant rewards despite the market's historically low valuations. Even if you have the liquidity to push down real rates and boost asset prices, the price-to-rent ratio may not necessarily go down. This simply indicates that in this uncertain macroeconomic setting, liquidity is the primary factor influencing expected future returns. The value of investments has increased significantly. On the other hand, if you have any contrasting opinions about this one, or if you do agree, then might as well share your thoughts in the comment section and we'd be more than happy to join in the conversation. Thanks for watching. This is Tech Tank Titans. And if you like this video, don't forget to hit the thumbs up button as well as the subscribe and bell buttons to see more of technology and stock market related content. Thanks again for watching and we'll see you soon.